Looking at Uber right here, we want to take a volatility trade. So the first reason that I even chose Uber was because it has an IV rank of 0. And so what I usually do when I come up with these sorts of trade ideas for volatility trade ideas, for options volatility type trade ideas, I go on to marketchameleon.com. And from there, I'll look at the elevated volatility and the subdued volatilities. And I'll make decisions for my underlyings from there. I am very indiscriminate upon my underlyings as long as the underlying has, if when I'm volatility trading, as long as the underlying has a volatility extreme, then I'm fine with trading it, and it should be liquid too. But I'm very product indifferent and I'm indiscriminate upon the product that I trade when I volatility trade, as long as it has a very elevated volatility or it has a very subdued volatility. So volatility extreme and liquidity. Those are two things that I need, and that's all I need right there. And I'm product indifferent, and I am indiscriminating against products when it comes to what I trade, when it comes to volatility trading. So with that said, I'm open to trading everything. And so I go on here and I say I want a long volatility type trade. And so first I start looking at the subdued volatility. So Market Chameleon is a great website to use. It's free. Just go on there, look for the volatility reports, the volatility rankings. You go on to subdued volatilities and you start to see that Uber, which is a fairly liquid name, has a IV percentile of 0. And so you have something that's very liquid with a volatility extreme, with the IV percentile of 0. So clearly volatility is too low, and it either has to have a big bounce from here down or it has to have a breakout. And so one of the two things have to happen, and this is a perfect time to get in there because IV percentile rank is 0. Even if you look at a raw IV percentile, it's actually pretty low, and it has kept on going lower and lower. And so now we're looking for a mean reversion right there. And so when it comes to that, we want to come with a trade in which we can bet that the volatility will go higher regardless of what happens to the price. So how are we going to come up with a trade like this? Well, first off, we can look right here, and what I generally would like to do with Uber right here is that since it's a fairly liquid name, we can use spreads, because usually when something's more illiquid, you like to use naked options because you don't want to buy the other option, and you would have to pay another bid-ask spread to buy that. Right here, though, it's a fairly liquid name, and we're able to use spreads right here to bet on what's going to happen. So if you're looking at this from a non-directional perspective, just betting on higher volatility, regardless of what's going to happen to the price or other factors, just a long vega trade, we could go out and we could look at the February 28th calls and puts. We could short the 41 calls, take long positions in the 42 calls, short the 40 spot 50 puts, take long positions in 39 spot 50 puts. So looking at this right here, if we do that and we take a long iron condor on a later expiration, so we're going to go to the March 13th expiration and take a long iron condor and then take a short iron condor on the February 28th expiration, we're now going to come up with a long vega trade that is non-directional. And so we want to be neutral in our delta, we want to be non-directional, and you're not sure whether Uber is going to go up or down, you just know that it has a very small volatility that's going to have a volatility expansion, then this is a good trade right here. Then, looking out for these calls on the 13th of March, we can take a long position in the 41 call, short positions in the 42 call, long positions in the 40 spot 50 put, and short position in the 39 spot 50 put. So when you do this right here, you're essentially going to pay a little over 30 for the puts, 40 for the call side on the long iron condor, and then for the February 28th short iron condor, on the call side you're going to earn about 30 in premium, and then in premium collected on the put side you're going to earn about 30. This makes it so that you've now come up with a trade in which you're only risking $5, and after these first short iron condors expire on the 28th, then we have basically a long iron condor right there, and we can sell another short iron condor on it, or another thing that we can just do is just keep the long iron condor and have all that profit potential right there. So you're just risking $5, and if you repeat this again and again and again, your max profit will be $180 to $200 if volatility stays the same, even if volatility doesn't increase, yet you're only risking $5 doing this trade. And so right here, positive theta and your long vega. So you're able to come up with a way in which you can bet the volatility is going to be higher without having to guess prices, and you can have time on your side. And so for those reasons, I love doing this sort of trade. It's very high risk, or it's very low risk, high reward with very high probabilities. The probability of profit right here is 90+%. The risk is only $5. Reward is closer to $200 if volatility stays the same. But volatility will likely mean revert. It will likely go higher from here. And so you're actually going to make more than that if you put on this trade right here. Thanks for watching. Until then, subscribe. We're going to have more of these coming out. We have trade adjustments too if anything goes wrong. If things go right, we also like to manage our winners. So we have more of those coming out, adjustments coming out. For other trades, we made a SPCE trade yesterday and a euro dollar trade yesterday. We might make adjustment videos for those, so please stay updated.